Hey, good morning options traders, and I've got a good question for everyone, for all of you who like to write naked puts. Now, for those who know me and know the channel know that I'm not a big fan of using naked puts. I think there are much better ways to go about collecting that premium, especially by using spreads, without all of the risk. But it doesn't really matter what I think, there are still going to be people who do it. So for those of you who do like to sell naked puts, or if you just want to understand how versatile options can be, this is going to be a really interesting video for you. So let's take a look at ratio put spreads and to see how they can be a substitute for selling puts. So first off, what is a ratio spread? Well, like the name implies, it is a spread, which means we're going to be buying something and selling something, and they're going to be in different proportions. So basically, we are going to buy one option and we will sell two or more of a less valuable strike. So assuming that we have the same expiration, the reason I have to write it this way in kind of this cryptic way is that it depends on whether you're using calls or puts. If you're using calls, you will buy a call and sell two of a higher strike call, because remember, higher strikes have to be less valuable. On the other hand, if you're using puts, you would buy a put option and sell two lower strikes, because for the puts, lower strikes are less valuable. So the ratio spread, though, is a way to sell options and potentially acquire shares. And a lot of people wouldn't really think about it in this way. So to see why, let's assume that you buy a $100 put, and let's say it's trading for 4, and you can sell two of the $95 puts trading for 2. So in this case, it would be a net debit of 0, or sometimes what's called an even trade. And all that means is that we've spent $4 on the purchase and we've collected $2 twice. So we've spent 4, we've collected 4, and so therefore there's no cash outlay and no cash inflows either, just a net 0 trade. Now in the real world, this will be fairly close to being true, unless there are some fairly heavy skews. And I've talked about that with the stock repair strategy. So they will usually be in a 2-to-1 ratio. Not necessarily perfect, so you might have a slight credit or a slight debit, but it's going to be close. But for this video, I'm going to assume that it's 0 just to make the numbers easier to follow. So if we do this, if we buy the 100 put and sell 2 of the 95s, this is our risk graph. So here's our bend at the long 100 put. Here is our second bend of the short 95 strike, right over the 95. So if you just look at this right-hand side, everything to the right of the 95 strike, that is the long put. If we just bought the $100 put by itself, this would be the risk graph. Now, if you sold one put, one of the 95s, you would just flatten out this way. You would have a vertical spread. But because we've sold a second one, we now create positive deltas. And that's what's giving us this risk graph. So on this side, this angled portion over here, everything to the left of 95 is 100 deltas. And yes, you can see that we have basically unlimited downside, just like if we owned 100 shares of stock. So that should be the first clue that there is 100 deltas hiding in this strategy somewhere. But one of the things that's really interesting is look at the max gain right here. If the stock closes right at the strike of the short at 95, we would have a $5 maximum gain. And that's because we have effectively bought the 95-100 put spread for 0. And so that would be the maximum gain, the difference in strikes. But because we have a max gain of 5, we can afford to have the stock price fall 5 points before we break even. And so that's why we're crossing right here at 90. So our downside break even right here is 90 points. So why is that interesting? Well, if you just sold the 95 put by itself, if you sold one of them, this would be your risk graph. And because we assumed the price was 2, that would be your maximum gain. So notice that if the stock price falls to 95, that's still the maximum gain of 2, but if it falls, we can afford to have the stock price fall by $2, the amount of the credit, before we break even. So the downside break even here is 93. See, for the ratio spread, it's down at 90, so a little bit lower. But the bigger question right now is how does this graph right here in blue, the ratio put spread, allow you to potentially buy 100 shares? Well, here's what's going to happen. If the stock price is below the short put strike, all you have to do is exercise your long put. So in this example, if you exercise your long put, you are going to sell 100 shares. Isn't that what happens when you exercise a put? You sell shares of stock. So in this example, we're assuming you don't have the shares. You've just got the ratio spread. So that would create a short stock position by itself, but you're going to get assigned on the 2 short puts. And if you're assigned on 2 puts, you are going to buy 200 shares. So think about it. If you are short 100 shares and then you're long 200 shares, your net position is 100 shares. Exactly the same as if you had sold 1 put. So your cost basis, however, would be 90 instead of 93. So yes, it is a way to potentially acquire shares, but like all strategies, you can't just look at the good sides. Are there drawbacks to it? Or what are the trade-offs? Yes, there are always trade-offs. And that's why when we looked at the ratio spread in blue and the single naked put in red, why we get what's called a crossover point, a point where the 2 strategies are equal. And if that were not true, there would be an arbitrage. All right, so we know that there always has to be a point where one strategy wins. In this case, you can see on this side, the red line sits higher than the blue. But over to this side, the blue line sits higher than the red. So yes, there are definitely going to be trade-offs, and that's why it's important to understand your strategies and your risk graphs. So if the stock happens to end up somewhere above this crossover point, you're going to end up with $2 instead of something less. And if it actually ends up above 100, you're going to end up with nothing with the ratio spread, whereas the naked put would at least return something. So this is where a little of the art side comes in. It can come down to how eager are you to acquire the shares? Are you more interested in collecting these put premiums, but you're okay with acquiring the shares? That's one view. Versus are you really trying to acquire the shares and just hoping for a lower cost basis? Of course, you can get even more creative, and let's say that you're willing to buy 200 shares, you could split them up. You could do 1 ratio spread and 1 naked put. And that way, if the stock does go up, you've at least got something to show for it. But for this video, I just wanted to show you that for those who like to use puts as a way to acquire shares, start thinking outside the box. It's not just about selling naked puts. There are many different ways to end up with the same position, but potentially, depending on your outlooks and your risk tolerances, end up in a better situation. So if you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.